Welcome to today's session. In this video, we are beginning our journey into IAS 16, the accounting standard that governs property, plant, and equipment. IAS 16 is one of the most important standards in financial reporting because it explains how companies should recognize, measure, depreciate, and present their long term tangible assets. These are the assets that help a business operate every single day. For example, buildings, machinery, vehicles, computers, and furnitures. It basically answers five big questions. When do we recognize an asset? What costs are included? How do we measure it later on? How do we spread the cost? And finally, how do we remove from the books? So let's get started and make IAS 16 simple, logical, and easy to apply. Before jumping to the answers, let's first understand the meaning or definition of property, plant, and equipment. According to IAS 16, property, plant, and equipment refers to the tangible assets which are used in the production of goods or supply of services. An example for production of goods could be a machine purchased by a manufacturing company. And an example for supply of services could be a diagnostic scanner which is purchased by a hospital for medical services. They also include tangible assets for rental to others. Example, a business buys cars and rents them to the customers. So here the car becomes a property, plant, and equipment for the business. It could also be those assets which are purchased for administrative purposes. For example, office furnitures, computers, etc. One of the main conditions for it to be a property, plant, and equipment, the asset should be expected to be used for more than one accounting period. In simple words, it covers all long term physical assets that help a business operate and generate revenue over several years. Before we jump into the technical explanation, let's pause and think about something very simple. Every business buys things from small items like pens and papers, stationery, to big investments like machines, vehicles, and computers. But do they treat all these purchases the same way in accounting? Definitely not. Some items are written off immediately as expenses, while others are recorded as assets and shown on the balance sheet for years. Why does this difference exist? What makes one item an expense and another a capital asset? This is where the concept of capitalization becomes very important. Companies don't capitalize everything. They do it only under specific conditions and for very specific reasons. The question here is, when should a company capitalize an asset and why is capitalization so important for accurate financial reporting? Let's break it down in a simple logical way. Companies capitalize an asset when all the three conditions are met. The first condition we saw in the definition itself, asset should be used for more than 1 year. The second condition is that it provides future economic benefits to the entity, like it helps the business earn revenue or operate efficiently. And the third condition is that the cost of the item must be measured reliably. Like, for example, I have an invoice or a contract or fair value should be available. Why is this being done? The main reason is accuracy. Capitalizing allows the cost of the asset to be spread over its useful life, thereby preventing the company's profit from dropping sharply in the year of purchase, and it ensures that expenses are matched with the revenue that the asset helps to generate. When a company capitalizes an asset under IAS 16, it does not just record the purchase price. The standard requires all the cost necessary to bring the asset to its present location and condition to be included. So, what are they? Three main categories of costs are capitalized. First is the purchase related cost, that is the purchase price, which includes import duties, non refundable taxes, and any discounts or rebates. The second one is the directly attributable cost. This includes all the costs which are directly linked to get the asset ready for use. For example, delivery charges, installation and assembly, site preparation, testing costs, professional fees, etc. And the final cost is the removal cost. That is the initial estimate of dismantling and restoration. So in future, if the place has to be restored, then the present value of that cost should also be included in the assets cost during our initial measurement itself. Together, these costs form the total capitalized value of the asset, ensuring that financial statements reflect the true investment made to bring the asset into usable condition. There is always a confusion whether the interest paid on the loan taken to purchase the asset can be included in the initial recognition of the asset. This is explained in IAS 23 and will be covered in a separate video. There are few costs which will not be included in the initial cost. Example, admin and general overhead when an asset is being constructed in-house. Initial operating costs, training the staff on operating the asset is generally not included in the initial cost. If there is any abnormal waste, those are also not included in the initial cost. Once an asset is purchased and capitalized, the spending does not stop there. Companies often incur additional costs during the life of the asset. IAS 16 calls these as the subsequent cost. Can subsequent costs be included? Here is the key point. Not all subsequent costs are capitalized. Only those costs that increase the asset's future economic benefit can be added to the asset's value, and the cost should be measured reliably. So, routine repairs, day to day servicing, maintenance, etc., do not increase the future benefits. Hence, we cannot capitalize those. We can capitalize only if it improves the asset. For example, it increases the capacity, it extends the useful life of the asset, or it enhances its performance. Once the asset is initially recorded, IAS 16 gives us two options for how to measure it in the years that follow. These are called as subsequent measurement models. The two models are the cost model and the revaluation model. Under cost model, the asset continues to be shown at the original cost minus the accumulated depreciation and minus any accumulated impairment losses. This is simpler, straightforward, and the most commonly used method. The other model is the revaluation model. Under revaluation model, the asset is carried at its fair value, meaning its current market value, and this value is updated regularly. Any increase to this value goes to the equity as revaluation surplus, whereas any decrease goes to the profit or loss. Companies choose the model based on their accounting policy, and they must apply the chosen model consistently to an entire class of assets. So, in summary, after initial recognition, an asset can either stay at cost or it can be revalued to reflect its fair value, depending on which model the company adopts. Once an asset is capitalized, we don't charge its entire cost to year one. Instead, IAS 16 requires us to spread the cost over the asset's useful life. This process is called as depreciation. Depreciation is simply a systematic way of allocating the cost of an asset over the years in which it provides the benefit. It ensures that expenses is matched with the revenue the asset helps to generate. IAS 16 tells us three things to consider when calculating depreciation. the cost of the asset, the residual value, which is the estimated value at the end of its life, and the useful life of the asset, which is based on judgment. Companies choose depreciation method which reflects how the assets are used. The most common method is the straight line method, written down value method, or reducing balance method, and units of production method. The details of these we will see in our next video. In brief, straight line method spreads the cost evenly every year. Reducing balance method charges more in the early years and less in the later years. And units of production method is linked to the actual usage. Whichever method is chosen, it must reflect the pattern in which the asset's economic benefits are consumed. So, in summary, depreciation is the tool that helps us to spread the cost of an asset fairly and consistently across its useful life. As per the standard, the residual value, useful life, and method of depreciation must be reviewed at least once every year by the management. Every asset has a beginning and it also has an end. IAS 16 tells us how to remove an asset from the books when it is no longer used. This process is called as derecognition. An asset is derecognized in two situations. First is on disposal, and the second is when there is no future economic benefits expected. Disposal includes selling the asset or scrapping it or even donating it. Once the asset leaves the company, it must be removed from the balance sheet. No future economic benefit means sometimes the asset is still physically present, but it cannot generate any benefit. For example, a machine that is permanently damaged or it's obsolete. In such cases, it must be derecognized. So, what do we record here? When we remove the asset, we compare the asset's carrying value to the proceeds which we receive from the disposal. This difference is recorded as gain or loss in the profit and loss as other income, and it is not recorded as revenue. So, in simple terms, derecognition means removing the asset from the balance sheet and recognizing any gain or loss that arises from its disposal or retirement. If you have any questions or doubts, just drop them in the comments. I'll be happy to help you out. If you found this helpful, please do like the video, share it with your friends, and subscribe to the channel for more such interesting lessons on IFRS, IAS, and advanced accounting topics. Thank you.